Doctor, have you ever wondered, what if I had more financial choices? I mean, what if I were in the position to move up retirement by 5 to 10 years? What if I felt really confident that I could send all of my kids and my grandkids to college? Well, these are some tips for you. My name is Vicki Rackner. I leverage my experience as a practicing surgeon, clinical faculty at the University of Washington School of Medicine, and serial entrepreneur to help physicians thrive. While I am not a financial expert myself, I know that money buys choices. For that reason, I have invited tax and wealth strategist Navi Dowty to join me today to offer his pearls of wisdom. Welcome, Navi.
Glad to be here.
Well, I know that for the past, 45 plus years, you have helped people build wealth. What does it mean to be wealthy?
What I have found is that the people that I see that are wealthy, call them middle class affluent folks, have three things: peace, freedom, and impact. We're talking to doctors today. I've helped doctors since the early 70s build their wealth and get to those three things. The impact part, doctors already have covered, but I found that a lot of doctors are really seeking more peace and more freedom. And by freedom, I mean walk away freedom. Not that they necessarily want to quit doing what they're doing. However, they would like, in many cases, to be able to quit. Move, as you said, move up retirement by several years.
Well, that's right. So we physicians and dentists are very privileged because, we're some of the top earners in the US. Why do you think it is then, maybe, that according to surveys, about half of doctors are behind in retirement planning?
What I've seen is it's losing money. And a lot of doctors have lost a lot of money over the years.
That's funny that you should mention that, because in my most recent book, I talk about the 9 money mistakes that doctors make. If you had to choose like the single biggest impact thing that doctors should be paying attention to, what would that single loss prevention strategy be?
It's a great book, by the way, and congratulations for writing it. I think what I've found, it's taxes, because taxes are your biggest expense for almost everybody, and certainly for doctors. Tax Freedom Day in 2019 was April 29th. Think of that. And that's on average. The average person worked until April 29th to pay all their taxes. And that includes almost half the people in America that don't even pay taxes. So for the doctors, Tax Freedom Day is much later, closer to the end of May, maybe even the end of June.
Well, Navy, I think that most physicians and dentists are working with competent CPAs. I mean, why are they losing money in taxes?
Typically, what most people do is they take their historic data to their CPA or accountant, whoever's doing their taxes, sometimes doing it themselves, sometimes their husband or wife, and that person just takes the historical data and puts it in the little boxes on the tax return. And remember, that's happening a year and a half later than what the data was generated. So in other words, next January, there's going to be income coming in for a doctor. That is probably not going to get reported on his tax return or her tax return until early the next year, or as late as October of the next year, if they extend their taxes. So the planning doesn't take place. And typically, the people they're working with to do tax planning or to do tax preparation really just do the tax preparation. They don't do the planning. And it's an easy thing to test. Just take out the engagement letter that you have with whoever's doing your taxes and look and see what it says. In almost all cases, it won't say anything about I'm gonna do planning to save taxes for you. It really says I'm gonna take your data and I'm gonna put it on the tax return and file it.
So maybe we've got a new tax code as of 2018. How has this impacted physicians and dentists?
In a lot of cases, the new tax code has actually cost them more money because they've lost so many deductions. Now, the tax brackets are a little lower, but the tax deductions have also gone down. And the biggest example of that would be the loss of state and local tax deductions in the Chicago area and in many metropolitan areas where our viewers here might be. You know, your property taxes on your house alone are $50, $80, $100,000 or more. You're limited now to only $10,000 of deduction for all your state and local taxes. Think of it, if you bought a new airplane or a new boat, all those sales taxes are lumped into that 10,000. So that many people can't even itemize it anymore.
Well, are there options?
There are always options, and if you follow the momentum of the tax law, the new tax law, there are many opportunities in there, as well as the things that were taken away. And also remember, that tax law expires on January 1st, 2026. So we have to plan very carefully, because we don't want to do something now that we can't undo on January 1st of 2026 when it goes back to the old rules, and most of the brackets go up by 25%. So just a great example for doctors that particularly own their own practice, the qualified business income deduction is 20%. Now, most high-income doctors do not get that because it phases out if they have too much income. But there are ways to fix that. So there's always a way around everything. The tax code, law, rules, codes, rulings, court cases is almost 75,000 pages. And what you have to think of is most of those pages are about the deductions. About 2/3 are about the deductions. And every single limitation that's in there is because there was a benefit a few pages before that got too good, and then they had to take it away. So there's always something you can do about your taxes. I even make this statement, and this may sound outrageous, but it's really true, and that is that every single line on your tax return is voluntary. Sounds outrageous, but it is true, because every line is there because of something you did that caused a number to get put on that line. And if you can do something to cause a number to be on that line, you can change that. So that's what tax planning is to me.
Okay, so many physicians are very conservative. They're very skeptical. Are you talking about things like moving money offshore to the Cayman Islands and avoiding taxes?
No, you don't want to do that. That's when you get into problems. No, there's so many things you can do. Just should I give you an example here at the end of the year?
Please.
Here's a great example right at the end of the year. A requirement is that you pay your taxes every quarter. So those of you that have your own business, your own practice, you're required to send in an estimated tax every quarter. Well, one of the exceptions, because there's always exceptions, remember, to every rule in the tax code, there will be exceptions. So here's one of the exceptions, and that is that while you have to pay money in every single quarter, here at the end of the year, if you want to make up for the taxes that you should have sent in back the first quarter, second quarter, third quarter of this year, you can't simply send in a big check at the end. They will charge you, they call it a fine, it's really interest on what you should have paid in. Here's an exception. If you have money withheld here at the end of the year from a payment, either your wages or maybe your required minimum distribution, if you're still working and getting income after age 70 and a half, you could just have it withheld from that. But if you have money withheld and sent in, then what they do is they treat it as though it was paid in pro rata over the whole year. And that's just one of the rules in the tax code.
So maybe here we are in the fourth quarter of 2019. Are there things that doctors can do to lower their tax bill this year?
Of course, there's always things you can do right up to the end of the year. That one I just said is one big one. I saw that saved a gentleman quite a bit of money. Here's another one. The biggest thing, the biggest impact you can have immediately on your taxes, just kind of tactically, is your retirement account. So make sure your retirement accounts are fully funded. If you are an employee of a hospital or a clinic, you're limited as to how much you can put in. If you have your own practice, it's about double that. And if you really need a lot of more deductions, you can get up into the hundreds of thousands of dollars. But here's the rule. The only two things that you can do after the first of the year to reach back and affect this year is an IRA contribution, and most of the doctors have too much income, so they're not going to be able to have a deductible IRA contribution, and it's not that much anyway, and your retirement accounts if you have your own practice. The key thing, though, is that you have to have those accounts set up by the end of the year. So if you need tens to hundreds of thousands of dollars more deductions, time is running out. You have to get those set up by the end of the year. And what's great about it is that you don't have to fund them by the end of the year. You can fund them right up through the tax due date, which includes extensions. So you could fund these accounts right up till next April or next October 15th, actually. The original due date's April 15th, but the extension will go till next October 15th of 2020. You could make that last payment to your retirement account then, and it would affect your taxes still this year.
Okay, so I just want to make sure I heard you correctly. I heard you say that there are still things that you can do now to cut your tax bill by tens to hundreds of thousands of dollars. Is that an exaggeration, or is that something that your average physician or dentist might expect?
For sure, tens of thousands. I mean, everybody's different, so I can't tell you how much you can save, but you can absolutely, if you have a retirement account set up, you can fund it next year, and it just comes off your taxable income. The other thing that can do is it can get your income low enough for taxable income low enough so that you qualify for the qualified business income deduction. That's another 20% off right off the top of your income, but it gets phased out if you have too much income. So an easy way to qualify for that 20% deduction is fund money into your retirement account. You can also use credits, oil and gas and solar power and land easements. Those are still things that you can do. Time's running out on those, but as long as it's all set up by the end of the year, you can still affect this year's 2019's taxes.
Well, Navi, thank you so much for sharing these pearls of wisdom. And Doctor, thank you for watching this video. Now, you've probably been impressed with Navi. I certainly am. In fact, I was so impressed, I asked him if he might be willing to deliver a live in-person private briefing